Good morning, everyone. Bob Iaccino from the Market Think Tank Show. New name for this show, but we are still brought to you by the Pure Exposure Growth Series, brought to you by Real Daily, as well as our sponsors, E-Trade and the CME Group. And I want to thank those guys, as always, for allowing us to bring this show to you. So I want to get right at it because we started off the prior week with a pretty, I'd say, a weak market considering how the year ended last year. And we picked up last week. We've now basically got all three major indices, and you throw in the Russell in there as well as being up on the month and up substantially. Now, this morning we had the Dow actually up overnight, and it's now showing a little bit of weakness. And we're kind of seeing that rotation trade, I'll say, die down, for lack of a better word. It's kind of dying down this morning as we get into it. So I want to bring in Mike Shorr, who is the director of trader education at Prosper Trading. He's also a very experienced options trader there. And Mike, welcome to your first appearance on the show. You know, we always give a lot of time to Prosper Trading, in part because I'm a little biased, right? I'm a subscriber to Prosper's options alerts. So I like to talk to you guys in every single show that I can. So as I'm talking to you right now, I'm looking at indices that are basically, you've got that kind of old story where the ES or the S&P or the SPY, whatever you want to call it, is kind of flat. NASDAQ is up, Russell is down, and Dow is down. So give us an idea of what you're looking at just going into this week on a more macro level.
Yeah, well, first, thanks for having me. I'm really excited to be here. And it's been an interesting start of the year for a number of reasons, but I mean, obviously the macro stuff that we've been talking about, but it's been extremely hard to make money to the downside. Other than closing your eyes and guessing and trying to make a play, and I'm talking about an intraday type of play, it's been very, very hard, which means that tells me, well, then just wait it out and look for something, get your wish list out and look for something to buy. And that's the way that I played it all last week and into the beginning of the week before that. That's what I'm looking at. Now we're getting into earnings, which is going to be even more interesting because you have obviously we had the banks that came out with mixed results, but now you have your Apples and Facebooks and everybody else that's really going to set the tone for the rest of the quarter.
Well, who's the really big names we got this week? I know we got Google and I know we got Facebook. Are those the biggest?
Apple on the 27th, unless I'm.
No, I think you're right about that. I think you're right about that. So
that's the one that I've actually been keying on, just because. Yeah, 27th after the close.
Okay, so we're talking about that's real big tech.
Right.
And that's kind of, do you look at it from a macro perspective? Do you think it's a negative when you're seeing this rotation back into tech? You know, we had basically 2020 was a year where tech was almost a flight to safety.
Yeah.
And, on top of that, like second part of that question, are your alerts that you send out to your clients, are they kind of slowing down? Is that a sign of anything for you?
No, no, it's been steady. I would say that I found it easier to day trade as opposed to mostly because of earnings, not because of anything that's going on macro-wise. That I've been just the style of my trading is not to play into earnings. Our friend Scott Bauer is way more into that, and that's what a big difference between our two rooms. Mm-hmm. But I am a little surprised that we're not seeing more strength in just your hard assets. And I'll just throw Caterpillar in there. That, I really thought that would be something that I would be leaning on and trading a lot more than I am. It's it's disappointed to a big extent. But if my whole feeling on this on any of this is don't try and be smarter than the market. If the market is telling you that the money's going into tech, don't fight it and don't try and be smarter than the market. And so go with it, but do it on a shorter term basis, because getting married to anything right now is just so, there's so many stories that are just so weird. I mean, take GameStop. GameStop is going to open up at 100 today.
I love it.
And I was like, and I was talking with our other traders on Friday, figure out a way that we can make this an efficient short at 40, and now it's at 100. It makes 0 sense. But what does that mean? That tells me just to stay away. I don't know what the game is right now. Somebody knows what the game is, and it's not me. So stay away from it. There's
I
plenty of
like
other things.
now the specific pieces of advice when you guys all talk, because that's one of the things I preach about all the time. And if I'm paraphrasing you incorrectly, let me know. Not every single trade is yours, right? You don't have to be involved in something just because it's moving. That's
Right.
sort of what you're saying, right?
Right. We trade when there's opportunity, not when we're open. And I say this all the time to to the people that are in my room. There are, and that's the nice thing about equities, is that there's a story out there. Go find it. And there's an efficient story to trade, not something that just makes 0 sense. Go find something else, and just don't jump in because that's what everybody else is doing.
Let me ask you something very specific, because again, I like to mention to people that I am a subscriber to Prosper. So Prosper does not pay me to be on this show, and they do not pay me to say that. Okay, so I want to
Well,
get that.
thank you.
I'm actually a subscriber to Prosper. So I get your watch list every morning.
Yeah.
When you send out that watch list of stocks you're looking at, what number one, what goes into that? And then number two, is that something where you say these stocks might move, or is there a process and you go, these are the stocks that there's likely to be a trade in? Because it's an exhaustive list.
Yeah. So what that list is these are stocks that I have specific scans that I do that they are meeting the parameters of what I would, if we were open, hey, this is what I would be looking to trade. So we don't have time to go into exactly how that is, but one is a short-term list. That's a long and a short, and then there's a longer term one. And it just gets things on the radar. I have my normal, what I call my usual suspects list, which is always up in the room, always, that if volume pours into one of those things, I know that I can day trade those things. These are specific stocks that are meeting certain parameters that I would normally be looking at, saying, okay, we have an opportunity here.
All right, I got about 3 minutes left with you before we go to Amelia Bourdeau. You have an Apple trade that you're looking at right now. Can you go through it in detail so that people can actually take it if they like it?
Yeah, and like, I do want to put this out there that this is not a signal yet, but I run a webinar on Saturdays for some of my subscribers, and we were just going through what my thought process is going into earnings. And a normal thing is, everybody's familiar with Apple. It make a really good just example. I know that. And I was looking at two things. I'm looking at one, Apple's performance over the last three, because nobody knows nobody publicly knows what's in that report, right? I don't know if Apple's going to go up or down. So I'm looking for a leveraged bet going into earnings. Apple over the last 3 years, or excuse me, the last 2 years are 7-1. Over the last 3 years, they're 8-3. That meaning that the stock goes up. And I don't care if they're going to beat if the number beats or anything. I care what the stock price does, because I don't get any
on the 8-3, Mike. I'm sorry to jump in.
I'm sorry. It's gone up 8-3. It's gone up 8 times. It's gone down 3 times. Over the last 2 years, it's gone up 7-1, and last year it was 3-1. So gotcha. Apple has a propensity to go up on earnings. I don't care why, right? I mean, I'm not an analyst. I'm just trading the stock price. So at the very least, I want to put something on that is either delta neutral or delta positive. So there's two things that
I'm sorry, go ahead.
No, there's 2 trades that I was looking at. Given where the implied volatilities are right now, they're targeting somewhere around 147 if it's a positive report, or it doesn't matter if it's a positive report, if the stock goes up, 147. So I'm looking at this week versus 2 weeks out. So that's the 29th versus the 12th call calendar, 147 call calendar. That was trading for about $1.30. And the way that I looked at earnings, or excuse me, what implied volatility is done afterwards, you're looking at, if I modeled implied vol correctly, that it's going to if everything works out, I think that you're gonna double your money. The other thing that I'm gonna do, still with the same underlying call on, hey, we're talking about flat to up. I'm looking at a delta skewed, so delta positive iron condor. So selling something like we're trading what 139, so trading like the 136, 138 on the put side, and then the 147, 149 on the call side for this week. So the 29th, that was trading for about $1.25. So you have a $2 wide iron condor that's trading for about $1.25, meaning that the worst I could do is lose 75 cents. If everything works out correctly, then you take in the whole $1.25, depending on your style. What I told them is that if you put on either one of those trades, I wouldn't be able to argue with it.
Mike, thanks for your time this morning. I really appreciate it. Mike, how can people get a hold of you if they want to learn more about those trades coming up in the next few days?
You want my home address?
I want to actually.
You want to just come by?
Cost me an Uber to get.
No, my email is mshorr@prospertrading.com, mshorr@prospertrading.com, or info@prospertrading.com. That email will get to me.
Guys, check out Mike Shorr. Email him. Take an Uber or a Lyft to his house and let him know how that goes, because I know he's a pretty good sized guy. Mike, thanks again for being here. We're going to go to commercial, and we will be right back with my favorite macro person on earth, Amelia Bourdeau.
All right. Thank you very much, Bob.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets, gold markets. Okay, I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
And we are back, everybody. Thanks to Mike Shorr for his first appearance. I thought that went well. But somebody who's been on the show before that I mentioned is my favorite macro person on the planet, is the founder of Market Compass LLC, Amelia Bourdeau. Good morning, Amelia. Thank you again. I know how busy you are because I talk to you a lot, and I get responses, and then I get a quick goodbye, which I love. So first of all, in terms of the market, you heard a little bit of what Mike and I were talking about. So in terms of like your general view, let's throw that same question, because the shift we're seeing right now, even though all four indices are higher right now on the month, is that we're seeing that shift away from the Dow and the Russell and kind of back into that NASDAQ, which 2020 I maintain was kind of the flight to safety. Right. So what do you see in terms of the current situation going forward for the month?
Thanks for having me on. It's great to be here with you and to see you in person, sort of via Zoom. But anyway, it's really interesting times right now. And I like what Mike said, there's always a story and you need to find it. So what the story is right now is the pace of vaccination. So we kind of have these new strains emerging for COVID, which is, very unfortunate, the UK strain. And there's reports today that there may be a new strain in California. The COVID is quite bad in California. And as you know, that state has been locked down. And there's been some kind of supply issues from the manufacturers of the vaccine, Pfizer, Moderna, in terms of getting these vaccines out. Pfizer is retooling a plant in Belgium, which is for Europe at least, stopping kind of near-term shipments of vaccinations, and so they can provide more capacity later on. Canada, for instance, has been informed by Pfizer that this week they will receive no vaccines shipped to the country. So it's being a bit tough. Even you see in New York State that they went through their allocations of week 1 through 5 for the vaccinations, and week 6 is incoming, but it's already Monday. So what's happening is it makes sense that shift back into NASDAQ, because we had thought that, look, this vaccine rollout's going to go really quick. There's going to be no hiccups. And we're going to have that rotation out of stay-at-home stocks into more general stocks and services. And now we're kind of retreating from that. We had that initial euphoria. Now there's some hiccups. It's still a very hopeful situation, but now it's just going to take longer, I think, than the market initially thought, say in November when the emergency use authorizations were given to these vaccines. So it's not surprising to me that we're back in that safe haven equity trade, which is NASDAQ.
So looking at the negative side then, Amelia, what has to happen for it to go from just a flight back into the safety of big tech, those stay-at-home stocks, I guess, into sort of a meltdown? I mean, can you kind of be prescient a little bit? And I'm asking a lot. What would have to happen in the current macro environment for it to go, okay, even tech isn't safe?
Well, we need to watch yields in the US. Of course, the back end of the yield curve, the 10 and the 30, have been moving higher. And it's interesting because they've been moving higher because of a better growth outlook. So now with the new administration in, and it's Democratic across the board, the market started to price in kind of a better global growth outlook because they thought they were going to get, and maybe we will, more fiscal stimulus. It's probably a correct assumption. And so you saw the 30-year yield rise and the 10-year yield. What would really melt things down is if the front of the yield curve, started to rise. That's highly unlikely because the Fed has been talking it down and has always said, obviously quantitative easing, and they've said that, they don't want to raise rates. They're not even thinking about raising rates. So they've been very clear on that, but you don't want to start a little taper tantrum here. So you kind of have this euphoria of more fiscal stimulus raising equities, but then you have to watch the yields and make sure that they don't cut off, any equity rally, say. So and you've seen that reflected in the dollar too.
Well, actually, that's where I was going to go, because you were a currency trader for a long, long time. But I want to ask you specifically, what I saw this morning in the Wall Street Journal is that mortgage forbearance is starting to increase. And if I'm speaking a foreign language to those of you listening, that means that it's starting to stall, I should say. And that means that lenders are becoming less and less apt to give people time, but late payments and stalling of payments are not falling. They're actually slightly increasing. Would that worry you from a perspective of what the Fed can actually control? You mentioned the Fed can control the short end of the yield curve, which obviously I agree. Do you think that the mortgage potential problem, or the sort of increasing of the negative side of the mortgage conversation, could have an effect, or does that not worry you?
It's not my main concern from global macro, but look, anything that impacts the consumer is going to impact the US economy. So I approach it more as our best hope of getting the economy more reopened than it is. Obviously, Europe is more shut than the United States and the United Kingdom too. California is quite shut, right? And it's the largest economy in the United States. And so our best hope of getting everything back on track and people back to work and the economy more fully functioning than it is to get these vaccines out there ASAP and to continue that rollout, get people back to work, get the services sector back opened up, or get people not fearing the services sector because they can't, social distance when they go and have services, get events back, coming in person and things like that. And so that really is our best hope of getting people back to work, getting the economy reopened. So I guess that's how I'm looking at it. But, we do have the rising mortgage rates are right now at this juncture a little troubling.
So let's get to kind of what your trading specialty is, because I mentioned you were an FX trader for a long, long time. And from a perspective of, I'm looking at the pound has had some really good movement in it late. The euro has had some spotty movement on it, but the structure of, obviously we like to trade the dollar and some of those other foreign currencies, maybe in the micros at the CME, and you also have a course on how you show people how to trade the cash. I wanted to mention that. But what are you looking at specifically in terms of a trade that people can act on either today or in the next few days?
A couple of things I'm looking at is the two currencies you noted, euro and sterling. So I actually like to be short euro sterling right now. And if you're trading, that's cash. But if you're trading the futures, it's the RPH1 contract. That's the front future of euro sterling. And I'm going to talk cash numbers, but because interest rates are zero, they're sitting around the same levels. So we're kind of sitting at a spot 88.79, and I see a move down to 87 the figure, and maybe even 86 the figure. And the reason why is because even though the UK has its own variant of COVID, which is very, very dangerous, and Boris Johnson, the Prime Minister, Friday said it could be potentially even more lethal than the regular COVID variant. What the UK is doing, very importantly, is they are having an aggressive vaccination campaign that's working. They vaccinated over 5.1 million of its people, and they aim to get 15 million people vaccinated by February 15th, and those are in the most vulnerable groups. And so right now they're doing a much better job at rolling out their vaccinations than Europe. And you're seeing that cap the euro, what you're talking about. There's also political turmoil in Italy that's capping the euro. So I don't see a lot of upside gain right now for the euro. Sterling, it's hard to trade just on its own against the dollar because we're above 137, the figure. So technically it's a little tough. That's very extended. But euro sterling since mid-December has been in a nice downward trend. And I think we're just going to continue that. So I see it to 86 the figure.
So I think this show is going to have the word extended used in it a lot as we go on. Mike Shorr used it a little bit. You used it there with the pound. Would you look at the pound as a long if it pulled back a little bit, or is it just way too over its skis?
I would look at it if it did pull back a bit. I mean, the thing that's helped the dollar, if we're talking about like the dollar index and the US dollar in general, is right. So we have equities rallying generally, and we have the US dollar declining, because it's a risk-seeking trade and you don't need that safe haven dollar. But we have the yields rising, remember that? And so that's kind of keeping a floor in dollar. So you notice the DXY index, which is the dollar index for the majors, it's just been trading above and below this 90 support, just slightly above, slightly below. We're not really on that downward trend, but if we broke 90 support in the DXY very convincingly and continued that downward trend, then yeah, I mean, you could see sterling higher for sure. But right now I like the cross. I like the euro sterling better.
You can find Amelia on Twitter. She's very active on Twitter. It is at Amelia Bourdeau. And I'm going to spell that because I have a last name that I have to spell for people all the time.
Yes, yes.
AMELIA BOURDEAU. Is that right?
That's right. Yes, that's
Yeah,
right.
I was reading it, but I'm going to act like I wasn't. Amelia, thanks again. Where can people find you other than Twitter? Is there anything else you want to plug here and get?
Yeah, you can also follow COVID charts. I'm an advisor to Ex Ante Data, and at Twitter at Ex Ante Data, EXANTE Data. We put out a host of foreign exchange charts that we update daily on Twitter, and also COVID charts if you want to track COVID as well. And you can also find me on my website, marketcompassllc.com.
Amelia, thanks again for being here. We're going to have you back. We always say you're a regular on our show, but I want to go from my favorite fundamental person to my favorite technical person, only because he's good at markets. I don't like him personally as much as I like Amelia, but we'll talk to him anyway. We're going to go to commercial. We'll be right back with Mike Arnold.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
So obviously, I was kidding about not liking Mike personally. I'm surprised he wasn't cussing me out in the background in the commercials there. He doesn't really cuss, but Mike Arnold is the chief technical strategist at Path Trading Partners. He is my partner in that, and we are both co-portfolio managers of the stock think tank. Mike runs a bunch of screens on stocks, on commodities, on everything. And Mike, I want to start off with lately, because we talk at least via email almost every day, is that you've honestly been having trouble finding some trades that you like, specifically in the equity markets. Can we talk about that for a minute? As you're seeing again, the S&P get a little bit stronger, but the Dow and the Russell still weak. NASDAQ up about 1% right now in the futures.
Sure, Bob. Yeah, I did a scan yesterday. Came out one of our proprietary scans, which we use to come up with stocks for the stock think tank. Ran the scan yesterday, came up with exactly 100 potential stocks. Out of the 100 potential stocks, there are 6 potential entries, 5 of them over 30% overvalued, 1 close to value. So there's 1 potential setup we have out of 100 stocks. And just scanning through the list period, there were over 50% of them that were in downward, still overvalued, but in downward trajectories. So no potential long setups. So majority of stocks in our scans are still highly overvalued, and there's no decent setups to get into them. I mean, the only setups I can find, which we don't really put in the stock think tank portfolio, is to literally go long the most shorted stocks.
So let me ask you that. Are we looking at a situation, because you said that they are in downward trajectories? Do we have a situation where we would be buying a pullback on those for the stock think tank, or are they in actual bear patterns?
They're in bear patterns, but still overvalued. That's what's interesting. So when we're seeing the Dow's not necessarily the strongest right now, but the NASDAQ, again, all the money is rotated back in there. The S&P is starting to bump up again. But what I'm finding is it's still not a broad market rally. You generally need a broad market rally to keep it very sustainable. This is a narrow market rally. I'm seeing a lot of overvalued things still pulling back, and they have a long way to pull back. So it's a very tricky situation trying to find decent setups with good reward to risk. There's some good technical setups, but the upside versus the downside is so skewed to the downside risk that you're risking $10 to make $1. And long term, that's not a great trade. Now, short term, if you're very nimble, you can jump in and out of things. But to run a medium term portfolio, we're not going to be getting in one day and out the next or the day after. So that's what's key. That is definitely key. It's hard to find these good medium to longer term setups with proper reward to risk where we can safely put people into these names without taking on a lot of downside risk potential, even if we're aggressive with the stops.
So we're obviously, we control our risk with the structure of the trades themselves, but we also don't, we're trying to keep our win percentage up. So that's what you're referring to when you're talking about taking excessive downside risk, is trying to avoid it. It's not completely unavoidable, but trying to avoid just upping that downward percentage, right? I mean, that's what you're referring to.
Yeah, and also I'm not trying to get people. Let's say stuff's you have a decent, okay setups, but it's highly overvalued, and we move our stop pretty far away. If we only get a slight rally or trade sideways, we have dead capital, and we're not going to put people in dead capital for 2 or 3 months, especially if it slowly starts pulling back. We're just tying up our portfolio capital with no major potential upside, which I'd rather than sit on my hands and wait for the decent setups, the longer term decent setups, which there aren't many right now.
So I don't know if you guys heard in the background, the bell went off and the opening ticks on the Dow is up 22 basis points. I'm sorry, down 22 basis points, or close to 0.25% lower. The S&P up 28, a little bit more than 0.25% higher. And the NASDAQ's up 1.15, and the Russell's basically flat, about 6 basis point lower. So I wanted to throw that out. Mike, in terms of When you look at a scan, you mentioned it went from down to, first of all, are you comfortable saying what that one stock that you might, because you're always giving us trades, but are you comfortable saying what that one stock that might be a long is, or you want to hold off on that?
I'm going to hold off on that because, again, here's with today's price action is blown out. This is the other thing I'm finding. We might get a good setup triggered, and then generally, if it's a good setup, it's off to the races. And sometimes I've seen these stocks gap up 5%. We're trying to get an entry even on the next day open, and they go up 5% and blow our reward to risk completely out of the water. So, and the one I was watching today is up on the open over 10%. So even if we got in on the open, it would have completely destroyed our reward to risk ratio, and we'd be in a position that has more downside than upside potential at this point.
Case in point, I asked Mike to look at net for our special plays portfolio. That's Cloudflare, and that opened up 3% higher on a gap up. So case in point, we didn't have a signal on that anyway, but if we did, we likely would have missed it. Mike, can I ask you about gold? I've been struggling to understand why gold hasn't kind of rallied with the VIX up 4%. It's rallying today. But why it's kind of not followed Bitcoin. And I don't need you to talk about the relationship to Bitcoin. Just what do you feel technically about gold? Because I know the fundamental side. I probably should have asked Amelia about that, but I'll probably ask Jim Iuorio on the fundamental side as well. What do you see on the technical side of gold right now?
Well, first off, across the board for commodities, I am bullish to very bullish.
Okay.
And gold falls in that. Silver falls in that. Copper has been bullish, but it's now overextended. I'm watching for a little pullback. Specifically gold, we keep getting these short-term reversal patterns, and the same with silver that just aren't following through. Both gold and silver are in this huge trading range. We had a little buy pattern in gold last week and in silver, hasn't followed through that much. My thing with gold, until we get back above, at least with the front month contract, until we get above about 1970 in the futures, I can't really start getting bullish again. And there's major support coming in right around 1780. So as long as we remain above 1780, but below about 1970, I'm bullish but cautionary, which means there's only some very short-term trades, which again, why we're not putting even an ETF like GLD or SLV in the stock think tank right now, because it's a very nimble play. At some point, it will be a very sustained long-term play, which I pretty much guarantee will be back in gold and silver, especially for a special play in the stock think tank.
Technically, do you like one better than the other, gold, silver?
I'm still a little more bullish on silver at the moment. It's holding up a bit better. It did trigger a minor double bottom pattern last week, but again, silver has to get back above about 575 on the front month contract before I really get bullish on it.
You also cover cryptos all the time, right?
I generally put up something 5 to 6 days a week on the Path Trading YouTube channel. Yes.
All right. So where can people get a hold of you if they need to get more information on these kinds of things that you're working on?
They can reach out to us at support@pathtradingpartners.com. They can just go to Path Trading Partners and fill in the contact us form. They can go to our YouTube channel, Path Trading, and every day there's videos going up for free that show the technical market analysis and some of my thoughts. I put up one on Friday about GameStop, and look at that. So yeah, I try to follow things that are topical and hot, and we got Bitcoin, even if they're very overextended or vertical, trying to save people sometimes from themselves and getting burned on some of these vertical up, vertical down moves.
Honestly, I think that's one of the best things you do. And by the way, Mike puts out really good commentary on that channel. about IPOs when they traded post IPO. A lot of people are interested in IPOs. It's a terrible idea to trade them on the first day, but Mike kind of guides you through the next few days. Mike, thanks for being here. Mike is on every single market think tank show that the Pure Exposure Media Group puts out. Now I'm going to go to somebody else who's also been on virtually every show we've done. He's going to be here virtually again. And we got an announcement. We're going to go to Jim Iuorio when we get back from this break.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
We are back. Market Think Tank brought to you by Real Daily. As you just saw, brought to you by the CME Group and E-Trade, as well as the Pure Exposure Media Group. I was talking to Jimmy in the background here, Jim Iuorio. He is a managing director, TJM Institutional Services. And he asked me about my trading cards. I still have trading cards. And not only, Jimmy, do I still have them. Can you see what that says?
Oh, yeah, no doubt.
I had more made. Now, I don't know if Lazar Printing is even still in business. Remember Lazar?
Oh, sure, yeah.
Lazar was
I
the
want
print.
those. Yeah, they're very, very functional, those cards. And just great note cards. We've just getting a habit of 35 years of doing that. Yeah, perfect.
They're great grocery list cards. And if anybody wants, I got a box of these. If anybody wants any, and you're cognizant enough to shoot me an email, I will send you some of these. Anyway, Jimmy, thanks for being here again, as always. And before we start talking about the markets, we have a little bit of an announcement, don't we?
Yes, we do. Friday, the first of the Futures Edge with Jim Iuorio. What time is exactly going to be on, Bob? Because I forgot.
I think we said 3:30 Central Time, but
that's what I think we said as well. Yeah, 3:30 Central Time. It's going to be good. It's going to be fun.
You can go to Jimmy's Twitter. He's been tweeting about it, and we will be as well at Pure Exposure Media Group. I'll be tweeting about it. But it's this Friday. I believe it's 3:30 Central Time. Half an hour to 45-minute show. Jim Iuorio. It's called Futures Edge. It's going to be futures focused, and it is also sponsored by E-Trade and the CME Group. So that's going to be an absolute blast. And again, before we talk about the markets, you got a podcast going too?
We're tooling around with the podcast. There's no official announcement yet. Me and Jeff Kilberg and Scott Nations, who are also going to be guests on the Futures Edge show on occasion, are talking about it. We did a pilot, so there's nothing officially announced. And we unofficially called it Markets Happy Hour, but we are open to suggestions from the Twitter world.
But let me know. I will let you guys. Obviously, we'll promote it as well because that's
cool.
Pretty good brains there. So, well, let's talk about the markets. We've got the markets up a little bit, and we've got kind of a mixed bag. The bell went off when I was talking to Mike Arnold. And as the bell went off, basically we had 2 up, 2 down, and now we have 3 up, 2 down. The Russell is up 9 basis points, NASDAQ 143, S&P up 33, and the Dow is actually down 51. The VIX is up 4.25%. So just off the top of your head, what does that mean to you, if anything?
Well, the last thing you said, the VIX being up. Normally, when we're at these all-time highs and been grinding higher, historically, we would expected a 12 or 13 VIX, and we still getting in the 24 neighborhood. To me, I think is amazing. And I usually view that differently as some people. I put that, like some people say, oh, people are worried, they're buying options. I say if people are worried, that's when we can continue grinding higher. And that to me belongs on my positive side of the market, when it seems to me that people are still buying options as protection. And I know I've spilled a lot of money buying options as protection this whole way. And I've been relatively bullish the last 10 months, as you know. Right now, I've changed quite a bit too. Fundamentally, I think that we price in an economic reopening. We've priced in, vaccine. We've priced in a profligate spending government and a very easy Fed. Those things we know are pretty much not going to change. And I'm starting to get worried that, buy the rumor, sell the facts sort of thing. I mean, Jeremy Grantham came and said he expects a big, huge dump in the next couple months. I'm not there. I'm still bullish because the technicals still look pretty good to me. And when those two worlds collide, I tend to go with technicals. So I'm still looking at it from the bullish side, and I am long Russell, but the trade I'm going to give is going to be S&P.
So you do like that people are buying protection as opposed to what a lot of people might think is more of a sign that things may be going lower. You're saying they're buying protection, therefore they're still long.
Right. I think we get the nastiest corrections when people forget about risk. And if people are buying options and propping up those prices, to me, they're not forgetting about risk yet. To me, it's like, a boxer dropping his guard because he thinks he's got everything under control. McGregor, we can do the McGregor metaphor from Saturday night, although he's probably just old and was tired at the time. But dropping his guard and getting tagged on the chin. I think that, to me, that happens when the VIX is like 12 and 13 and everybody's selling options because everyone thinks we're going to the moon with no worries.
So it's kind of a two-tiered equation for you. It's a good example. It's as to what I'm seeing in the market is what I just mentioned when I was on with Mike. I said Cloudflare, which is the ticker is NET. I was looking at that last week. We were looking at it potentially putting it in our portfolio under the special plays heading in the stock think tank, and it just kind of ran and opened up 3%, but then it dropped down to up 1%. It was kind of like, I'm seeing selling as we rally. You're seeing buying of options. Do you see a conflict there?
Yeah, I definitely do. So selling rallies goes on the negative side of my ledger. This is why unfortunately, it's never just everything on the green light side of it, which by the way, if everything ever does just completely get on the green light side of it, that's when I get even more worried. But that Cloudflare stack you mentioned is funny because I have that. I barely even know what it did. Just someone alerted me to a chart pattern that I really loved, and I bought some call spreads and got assigned to be managing that position. It's nice to hear that it's up today. I haven't checked it. But I definitely think when we start to see names being sold during the day and closing poorly at the end of the day, that to me starts to get negativity. I think late money is smarter money. Maybe that comes from growing up near a horse racing track ever. We always try to watch the odds to see the late bets come in because it seems like the late money is the smart money.
Was that Melrose?
No, Arlington Park.
Oh, I grew up in Arlington. That's right. I should know that already.
Yeah.
Let's talk about your trade. You've got a call fly, which the first thing I noticed about it is you've got slightly different room between the outer strikes.
Right. I hate buying a standard call fly, being right on the direction, and then losing money if it blows through your middle strike on the upside. So I tend to do these uneven call flies. So here it is. It's end of month. It's January 29th, which is Friday, which is the same day we're launching Futures Edge starring Iuorio. So it's Friday, January 29th. Buying the 38.50, 38.75 call spread. So you're buying a call spread that's 25 ticks wide. We'll use this end, 25 ticks wide. And then we're selling the 38.75, 38.95 call spread. So you're buying a 25 tick wide, selling a 20 tick wide call spread. So here's the risk. I paid 5.25 for this, and I have a bunch of trades on like this, and I use them all the time because I hate if it flies through the market and goes way above the upper strike, you still make 5 ticks, the 25 minus the 20 tick you sold. So here's your risk. If the market goes down, you can lose your 5.25 ticks that you paid, which is $262. And you can, if it goes to the middle strike, 38.75 and settles there, you make $987, essentially $1,000. Keep in mind, I never, ever have hit one of these out of the park where it settles at my strike. And that's not even what I'm going for. When I put in a fly like this that has an upward delta, if I pay 5 ticks, if tomorrow I could take it off for 10 ticks, I probably would. What I like to happen is that the market kind of mills about where it is right now, which is what, about 38, 35, we'll call it 15 ticks under the strike, I think is when I last looked. I'd like it to mill about for a couple days, and then on Thursday and Friday start its up move and get a little higher torque as it moves through that bottom strike and maybe make 15, 20 ticks out of it. But you're not going to make the 25 ticks. It's unrealistic to think you are. But I like these trades because it to me, it feels like it slants the risk reward in my favor.
That's getting up there. We're 38.46.50 in the March ES, right?
Wow, I shouldn't have taken my eyes off the market. Okay, good.
Trying to move, but like if you get a quick, so does time factor into this? If you get a quick double, are you out? Or if you get a longer double, are you out? I mean, is that?
Yes, if I get a quick double, I wouldn't get that today, because even if it shot to the middle strike, I can't imagine that it doubles in price today. But if I get that even by the end of the day tomorrow, I probably get out. Going further in the week, because I held it a little longer, I'm going to want a little more from it. And again, if the market explodes higher, I paid 5.25 for this. It's going to be intrinsically worth 5 if the market's above that top strike 38.95. So I'll lose my quarter tick, which, by the way, that's painful. When I get the direction right and lose, a quarter tick on it, I hate that. But I most probably will have covered it before then.
I got to ask you 2 fundamental things before we go over to Jay Shorr from Investors Alley. Number 1 being, does it bother you that holiday spending was bad, that retail sales was bad, or do you just say, well, it was pulled forward after the first stimulus and it's all going to even out in the end? Does that bother you?
Yeah, it only bothers me the tiniest bit. I still, it's the dead of winter. I still think that people are worried to go out. Finally, just on Saturday, the suburban Cook County restaurants were allowed to have some indoor dining. So I think we're still in people's minds in a very, very dark place. But I do believe that the market's telling us, and what I believe also is that come, let's say, April 1st, that we'll be coming out of this, because the vaccines will have reached critical mass. Will also, that normal economic boom that happens when weather breaks for most of the country and people start going outside, spending money. So if you believe that concerts and weddings are actually going to happen this summer, which I still do, then I don't worry about that current data.
So the next thing I wanted to ask you is, article in the Wall Street Journal this morning said that mortgage forbearance is stalling. And I'll repeat again for anybody who just joined us, mortgage forbearance stalling basically means that the lenders are not as active in terms of forgiving people who are behind on their mortgage. So that to me means either mortgage delinquencies are increasing, or the delinquencies that are ongoing are being treated a little bit more harshly. Amelia mentioned a minute ago, before Mike Arnold was on, that she was looking at rates rising a little bit. They haven't risen in quite some time. She wasn't predicting it. She just said she was watching it. Does that bother you from a perspective of equities, or is that just flight to safety with equities is going to remain?
To me, it bothers me economically, which could ultimately bother me from an equity standpoint. But what I've thought the whole time, and we've talked about this before, that when there's genuine bad news, we have a Fed that's so trigger happy, a government that's so trigger happy to come to the rescue, that I think for risk asset prices, it still doesn't drag them down, because the Fed will just hit the gas a little more, start talking rates, because longer end rates have actually started to come up quite a bit. I mean, if 1% is, if you consider that a fat, sexy rate for the 10-year, and the Fed could put a stop on that at any time. They're mostly the buyer. They could just all of a sudden, instead of buying however many freaking trillions they're buying, they'll buy a few trillion more. So I think that all the bad news at this point in time, which again, I reiterate that economically, we're still in a pretty dark time, but they have an answer to that. And it's not a great answer long-term, by the way. As a matter of fact, you mentioned gold before. I'm long gold. I'm long Bitcoin. I play the Aussie dollar, the Canadian dollar for the long side. And one of the reasons I'm long stocks as well is because I believe they're being way too cavalier with the currency. And at some point in time, we could start to price in a little bit of a currency crisis.
Jimmy, where can people find you for more fat, sexy call flies like the one you just did today?
No doubt about it. Fat, sexy call flies at Jim Iuorio on Twitter, which is JIMIUORIO. I tweet mostly about markets starting today and not about stupid government policy that's dragging us all down. At least I'm trying not to tweet about that as much. So if you hate those things, just ignore them, because there's usually about market tweets at about a 1-to-1 ratio.
Yeah, try not to respond to the political stuff if you're on the other side, because the market information is too valuable for you to get angry.
And I'm not on a side politically. I'm in the middle politically.
January 29th, 3:30 Central, 4:30 Eastern, Futures Edge with Jim Iuorio. I believe I'm going to be honored enough to be the first guest on that, so I'll be giving trades this time instead of talking about trades. But
we're going to
Jimmy, and we're going to go to another break, E-Trade, CME, and then we're going to go to Jay Soloff, one of my favorite options guys out there.
This is my headquarters. This is where I trade and manage my portfolio. Since I added futures, I have access to the oil markets and gold markets. Okay. I'm plugged into equities, trade confirmed. And I have global access 24/7, meaning I can do what I need to do. Then I can focus on what I want to do. Visit your online broker today to learn more.
So our friend Jay Soloff, the chief option strat at Investors Alley, is a little bit happier about football than he is about markets this morning. He is a Chiefs fan. You're in there. You're out there in Kansas City, right, Jay?
Well, that's where I grew up. I'm in Arizona now, but born and raised in Kansas City.
So I will say this: I was rooting for Buffalo because I just love the Josh Allen story, but I bet on Kansas City. So I love doing that. Even when the Bears are involved, I'll bet against the Bears. And my strategy is that I'm happy either way. That's my strategy. So I was happy either way, and I love watching Mahomes. So if you can we can talk about that offline as much as you want. That kid is so good. And the fact that the Bears could have had him. Anyway, we have a market where earlier on, stocks were up. All four stocks were up. As we came into the open, the Dow was down, the Russell was down, the NASDAQ was up, and the S&P was up. And as I speak to you right now, we've got the Dow down about 66 basis points, S&P about 22. The NASDAQ's up 1.35%. You know, I always say basis points, and I should point out that, for example, 25 basis points is 1/4%, 50 basis points is 0.5%. Just for people who don't realize that I might be talking in trader speak. Finishing up, the Russell is up 17 basis points. And the VIX is up 4.84%. What stands out to you in any of that, if any of it does?
Well, I want to parrot Jim here. The VIX remains elevated, right? And that's the thing that I think, at least in the options world, that's the stuff that we're looking at. The VIX is implied volatility. It's looking at the next 30 days. If you look at realized volatility for the previous 30 days, it's something like 10 or 12. I mean, it's this relatively low number. And then you look at, and the VIX is a little bit more complicated than your straight implied volatility, but roughly speaking, I mean, we're talking about, a 23% implied volatility compared to a 10% realized volatility, where there's this huge gap that's not normal. And the question is, why? What are people worried about? And I mean, that's a complex thing, right? It's never quite obvious. It could be hedging. It could be all the buying. I mean, if you looked at, like you mentioned GME earlier, I mean, looked at all, the Robinhood, Wall Street Bets people, buying out of the money calls like crazy. Well, buying options is, can raise the VIX, whether it's on the call side or the put side. So there's a lot of different things, although mostly it's a pandemic hedge. There's just still a lot of uncertainty, particularly with the vaccination rollout in that area. So I just think VIX is going to fade slowly over time. It's not going to be one of those things where we get back to that sub 15 normal number anytime soon.
So do you think of it the same way as Jimmy does, where he sees people buying protection and that actually kind of reinforces his bullishness? Because honestly, I think that's probably a little bit of a unique perspective, but maybe I'm wrong. I should maybe ask everybody that.
I don't know. I might be bullish for other reasons, things like sector rotations and stuff like that. I'm not, I don't necessarily think we're going to wake up and have some some massive sell-off. But I think what goes into the VIX is probably a lot more complicated than just hedging, right? I mean, again, there's a lot of option buying and going on across the board. Not to mention some of these stocks that are flying, people are looking for reversal, so they might be buying the puts. People are buying calls because they're trying to ride the momentum. You have a lot of option buying going on across the board, and it's keeping the VIX elevated despite whatever reasoning there may be behind those option purchases. So I could see it as a bullish indicator. But it's like, yeah, I don't expect the market to plunge anytime soon, but I'm also not super bullish overall on market, maybe particular stocks. Again, sector rotation is probably a big theme this year.
So look, you've been doing equity options for quite a bit of time. So I'm going to ask you a question. This might be a little bit of a curveball. When I was on the trading floor, and Jimmy was down there as well at the time, he actually stood just down and to my right. If somebody came in with a high volume, what we used to call large size, right? High volume of a particular contract. And if it was a big name like Morgan Stanley, Goldman Sachs, somebody like that, I used to see a lot of guys calling around to their clients, their institutional clients, and saying, Goldman is bullish, they're buying. Morgan Stanley is bearish, they're selling. And my stance was always, you have no idea what's going on the other side of that trade. So if you want to inform your institutional client that someone is buying or selling, that's fine. But I think assuming that means they're bearish that particular security or asset, or bullish that security or asset, that was a load of shit, quite frankly. Now, do you feel it's the same, or am I out of my tree in terms of stock options? I want your opinion. I don't want support for mine. That when somebody's coming in with unusual options activity, and you hear that phrase, they're buying all the time, and I don't know who they is. So you can see I'm cynical about the whole concept. But do you think that necessarily means that someone is predicting something's going to happen?
It depends on what you're talking about. If you're talking about in an index, you are 100% correct. You don't know what's going on the other side. Now, the thing about flows is that you start to get, if you're in it long enough, get an idea of who's doing what. So like, the JP Morgan has their huge hedged equity hedge fund, and every quarter they roll, millions of dollars worth of options in the SPX or indexes, and they roll it, and you see this huge order and what it is, and that's not related to some sort of market timing. That's just them rolling their, this huge $1 billion, mutual fund, or, from one quarter to the next. On the other hand, if you're talking about like a less liquid individual stock, and you see, it's got an average of 2,000 options